My investment journey started in my uni days, and before that, I used to check the teletext prices of stocks for my mom, so naturally the stock market was always intriguing to me. During my uni days, I remember spending a lot of time in the canteen with a friend of mine, and we used to chat about trading ideas and stuff. It was a lot of speculation. I really got serious into dividend investing maybe about 10 years ago only. Today I'll show you a glimpse of my journey, where I've built it to right now. And everything starts small. At first the dividend is only $100, then it becomes $500, and very soon it becomes $1,000. But I also believe that if the dividend that you receive is less than $100, for example, quite possibly the first thing to work on is income. The investment size is quite possibly not meaningful enough yet. So just keep working on income, be frugal, and you have a lot of spare cash to get invested. And previously, CDP accounts used to send checks back to our houses, but nowadays it's just paid directly via PayNow. And this is a quick glimpse of what is being received on my end. Realize that this stock in particular paid 500 plus in terms of dividends. Then you may be having this question: why do I buy stocks and put them into CDB account? Because that requires a traditional brokerage, correct? It's more expensive than a discount brokerage. Because if you buy, for example, $10,000 worth of shares, you realize that it costs about $30 in terms of brokerage charge, whereas a discount broker could be charging you less than $10. So my quick answer to that is discount brokerages tend to promote a lot of over trading. You also realize that once you park your money inside CDP, the brokerage charge is more expensive. You tend not to move them too much. I do have both, and I can quite simply say that those in my CDP have sat there for way longer than those that are in my discount brokerage. And more than that, in discount brokerages, there is easy access to margin, which means also you could get leverage and you could become overly aggressive in terms of how you approach the market. Again, dividend investing is slow and steady. And stay with me a bit more, I'll show you a calculation on what I'm receiving on two particular accounts. The first is the CDP account, which are shares bought with cash, and the other is my SRS account. Shares in SRS account also gets dividends. So this is just to clarify things, and this is a quick screenshot as to something that was paid to my SRS account in October. So without further ado, let me show you a tabulation of what I have in these two accounts as per what I promised. This list over here does not include holdings I have in Tiger, Weibo and Momo, which are discount brokerages. There are also some overlaps in names between the CDP and SRS account. That's why if you see in terms of total weightage percentage, I've actually combined those that are overlapping in both accounts. I've also removed specific names because this is not a stock tip discussion. I'm really trying to describe the process of slow and steady and building up with a long-term goal. But as always, if you've been following the channel, the names are quite obvious because before I buy a share, I do an extensive research and I will definitely create a content to share the findings with you. So as always, smash the subscribe if you want good research that can help you explore gems in the Singapore market. You'll see also in the yield compartment in red, those are adjustments I've made because some of them are seeing much better dividend payouts for 2023. So I have to reflect something that's accurate but still on the conservative side. And one sector in particular is the hospitality sector, which is seeing strong recovery. This tabulation is done as of 1st of February 2023. Total value of these two accounts are about $501,000 and total dividend could be $22,613. This of course is built up gradually over more than 10 years of investing. And with that, actually 5 key nuggets of wisdom that I'd like to share with you to help you in your own dividend portfolio. The first is that when you look at this list, you realize that there are a total of only 14 unique names inside. 2 are duplicated in cash and SRS. A few more names are on the trading platforms, which are not reflected here, and a few are in my wife's name. But in total, I think the names are 20 or less. That's why speaking to here, I would suggest if you're looking to buy a stock after doing research, you need to have this mindset of, if I want to buy this in, this needs to be better than what I existingly have. If it is, I might replace it. You cannot have a list whereby you say yes to everything and keep adding that list and it becomes 50 names and 100 names. I've actually seen that in private clients brokerages, and that suggests that there is insufficient research done. There's insufficient thought process put to the purchasing itself. Again, discount brokerages make it so easy to press a button and buy. And this quote by Peter Lynch really works. Investing without research is like playing stud poker without looking at the cards. You need to research carefully and slow down your buying process. Some experts have even suggested thinking of a price first before the market opens so that you're not swayed by the volatility itself. Another interesting quote to share with you by Joel Greenblatt. He's actually a hedge fund manager. The secret to investing is to figure out the value of something and then pay way less. Again, it requires extensive research whereby you're not buying a stock for fun and you're not buying an amount that is so insignificant. I have one in particular that is only 1% allocation. That is about $4,200 worth. I kind of regret that purchase, But that small cap industrial stock is just too illiquid right now to cut losses and move on. That's why I'm still holding on to it. Again, you need to size the investment properly so that you have skin in the game. You are interested to keep track of its developments along the way. As well as when you do stock investing, you are looking to track the business. If not, you may be much better off with a diversified approach through funds or ETFs. And you know, some people say diversification is for idiots. They don't believe in diversifying, they believe in concentration. Which leads to the next point I'd like to share with you. Diversification is important. The biggest weight in my portfolio is only 18%. Never go all in one particular stock. Diversifying has its benefits. It helps you ensure that you are not overly aggressive and not overly confident. I used to think that the maximum that you should hold is only about 20%. But Warren Buffett, through Berkshire Hathaway, owns about 30% allocated into Apple. So if it's the goal of investing, maybe the maximum that you and I can allocate to our portfolios is about 30%. But beyond that, there could be over-concentration risk. If you like REITs, don't just look at Ascender's REITs. Prospect a bit wider, see the different REITs, and therefore it gives you a better comparison point and know which is actually good value. If you like Tesla, don't be overconfident by everything into Tesla. Because as Tesla share price has shown, the volatility is massive, and if you are not used to it, you could make wrong emotional decisions. I used to have a lot of exposure in commodities, and I had to right size that. And as you can see, there are only 2 pump stock companies that I currently own, and I've actually thought through hard about them, and I'm pretty comfortable holding on to them. The third thing to learn is to do reinvestment. As you can see over here, there's a data center REIT which has an odd lot, 14,099 shares. Now the reason I got 99 shares is because I subscribed for the scrip dividend. And sometimes these scrip dividends, they are issued at a discount, which means you can actually purchase it below market price. I don't own bank stocks, but I do know from my mom's trading account that OCBC also has scrip dividends, and it's a way that you can accumulate shares at a discount to the market price. And in the previous tutorial, I've actually covered, when you reinvest, you can actually compound your money faster, and over time, you'll see that that amount can snowball to something way bigger than your initial capital. The fourth point is to start early. How early? Previously in my time, stock trading accounts were open only after the age of 21. But these days, you can open from the age of 18. And for myself, I actually started contributing to SRS from 2010, as you can see over here. That means I've actually started investing with my SRS as early as 26 years old. I know I'm pretty old right now, but I've actually started my SRS journey way earlier than many people. And that's why I have quite a big amount inside my SRS right now. I've actually done a previous tutorial talking about my SRS. I think it could grow to $1 million. And if you are interested, follow on with that also. And last but not least, I have a fifth point to share with you, looking back at my journey. And the keyword is actually patience. You know, when you plant a tree, it takes years for the fruits to bear, correct? In applying that logic, for example, my investments into hospitality companies, I also need to give them time to realize their full potential. Jumping in and out is simply the wrong move. Buying and holding is quite simply more effective. What about commodity names in my list? You can see that the dividend yield from them are pretty strong. And that's because they have very low debt ratio and commodities are on the boom right now. However, in the near term, they've kind of fallen out of flavor. So I do need to give them time to realize back their full potential. And jumping in and out and jumping to the tech rally that's happening right now and jumping to fixed deposits is just not simply the way to go. Be patient, especially if you are seeing a bear market, because timing the market is more important than timing the market. And you make the most money in a bear market, it's just that you don't realize it at that point of time. This is a very interesting quote to keep close to heart. And with that, I'd like to introduce you to some of my previous tutorials. This one touches on the SRS portfolio that I'll be building towards. And this one talks about dividend investing. Maybe either of these could help you further in your journey, and I wish you all the best. Take care as always. Thank you for sticking right to the end. Goodbye.